While traditional banks offer 0.5% interest rates, DeFi protocols are generating 15 to 25% annual returns for those who understand how to navigate them safely. But here's the problem. Most people approach DeFi yield farming like gambling, chasing the highest APYs without understanding the underlying risks or sustainability. In this comprehensive guide, I'll teach you the institutional framework that professional DeFi investors use to generate consistent, sustainable yields while managing downside risk. The same systematic approach that separates long-term wealth builders from those who get wrecked chasing unsustainable returns. Before diving into specific strategies, let's establish the fundamental principles that drive sustainable DeFi yields. What creates real yield in DeFi? Unlike traditional finance, DeFi yields come from actual economic activity. Trading fees from decentralized exchanges, real revenue. Lending interest from borrowers, real demand. Protocol fees from genuine utility, value creation. Staking rewards from network security, economic function. Sustainable versus unsustainable. Yields, professional DeFi investors distinguish between different yield sources. Sustainable, based on real revenue and utility, 5 tons to 25% APY typically. Token incentives, protocol rewards to bootstrap growth, can be 50-500% APY. Ponzi mechanics, unsustainable models that always collapse, often 1000% plus APY. The risk-return spectrum. Every DeFi yield opportunity exists on a risk spectrum. Blue chip protocols, Aave, compound. Lower yields, highest safety, established DeFi, Uniswap curve. Moderate yields, proven track records, emerging protocols. Higher yields, increased smart contract and execution risk, experimental new protocols. Highest yields, highest risk of total loss. Time horizon considerations. Professional DeFi investing requires matching strategies to time horizons, short term, 1 to 3 months. Focus on established protocols with proven yields, medium term, 3 to 12 months. Can include emerging protocols with strong fundamentals, long term, 1+ years. Strategic positions in protocols you believe will dominate their sectors. Professional DeFi investors use systematic frameworks to evaluate yield opportunities. I've developed the DeFi method, decentralization and security, smart contract audit, history and quality. Decentralization of governance and operations, track record of security incidents and responses, multi-signature requirements and emergency procedures. Economics and tokenomics, revenue model and fee structure, sustainability, token distribution and vesting schedules. Value accrual mechanisms for token holders, inflation, deflation dynamics and supply mechanics. Fundamentals and usage. Total value locked, TVL trends and composition, daily monthly active users and transaction volume, real utility and product market fit evidence. Competitive positioning within the sector. Integration and composability. Integrations with other major DeFi protocols, composability benefits and risks, ecosystem partnerships and development activity, cross-chain capabilities and multi-chain strategy. Scoring system, rate each category 1 to 10, weight by importance for your strategy. Security-focused investors, weight D heavily yield-focused investors, weight E and F more growth investors, weight F and I more conservative investors. Require minimum scores across all categories. Let's examine the main categories of DeFi yield generation and their risk-return profiles. Strategy 1. Lending and borrowing. Provide liquidity to lending protocols like Aave, Compound, or newer alternatives. Typical yields, 3 to 12% APY depending on asset and demand. Risk factors, smart contract risk, liquidation risk if borrowing, rate volatility best for conservative investors wanting steady, predictable returns. Pro tip, monitor utilization rates. Higher utilization often means higher, more sustainable yields. Strategy 2, liquidity provision, AMM. Provide liquidity to automated market makers like Uniswap, Curve, Balancer. Typical yields, 5 to 30% APY from trading fees plus token rewards. Risk factors, impermanent loss, smart contract risk, token price volatility, best for. Moderate risk investors comfortable with price exposure. Pro tip, choose pairs with lower correlation to minimize impermanent loss. Strategy 3. Staking and governance. Stake tokens in protocols for governance rights and fee sharing. Typical yields, 4 to 20% APY from protocol revenue and staking rewards. Risk factors, token price volatility, governance risk, slashing conditions. Best for long-term believers in specific protocols. Pro tip, look for protocols with actual fee revenue, not just token inflation strategy. 4. Yield aggregation use. Yield aggregators like Yearn, Beefy, or Convex to optimize returns. Typical yields variable, usually 8 to 25% APY after fees. Risk factors: additional smart contract layers, auto compounding risks, strategy risk. Best for hands off investors wanting professional management. Pro tip: understand the underlying strategies, don't just chase the highest advertised APY strategy. 5. Cross chain arbitrage: exploit yield differences across different blockchain networks. Typical yields 10-40% APY when opportunities exist. Risk factors: bridge risk, timing risk, gas fee volatility, execution complexity. Best for advanced users with significant capital and risk tolerance. Pro tip: factor in all transaction costs and bridge fees before executing. Professional DeFi investors spend more time on risk management than yield optimization. Smart contract risk assessment, audit quality. Look for audits from reputable firms, consensus, trail of bits, etc. Audit recency. Recent audits for any major code changes. Bug bounty programs, active programs indicate ongoing security focus, time in market. Longer operational history generally indicates lower risk. Liquidity risk management. Exit liquidity. Can you exit your position quickly if needed? Protocol liquidity. Is there sufficient TVL to support your position size? Market liquidity. Can you sell received tokens easily? Lockup periods. Understand any time-based restrictions on withdrawals, counterparty and governance risk, centralization risks. How much control do founders, shark teams retain? Governance token distribution. Is voting power concentrated? Emergency powers. What can admins do without governance approval? Community activity. Is there active engaged governance participation? Portfolio level risk management. Diversification. Don't put all funds in one protocol or strategy. Correlation awareness. Many DeFi protocols are highly correlated during stress position sizing. Use the same risk management principles as traditional investing rebalancing. Regularly assess and adjust positions based on changing risk to reward. The 5 to 25-70 rule for DeFi allocation. Conservative approach many professionals use. 5% in experimental, high-risk protocols, learning positions. 25% in emerging but proven protocols, growth allocation. 70% in blue-chip, battle-tested protocols, core holdings. Once you master the basics, these advanced strategies can enhance returns while managing risk. Strategy 1. Delta-neutral farming. Earn yield while hedging price exposure. Provide liquidity to earn fees and rewards. Short the same tokens on derivatives, platforms, net result, yield from farming minus hedging costs. Best for wanting DeFi yields without directional crypto exposure. Strategy 2. Leverage farming. Advanced. Use borrowed funds to amplify yield positions. Borrow stablecoins or ETH to increase position sizes. Must ensure yield exceeds borrowing costs after fees. Significant liquidation risk if done incorrectly. Best for experienced investors with sophisticated risk management strategy. 3. Protocol token strategies. Sophisticated approaches to protocol tokens. Vote escrow models. Lock tokens for boosted yields and governance power. Bribe markets. Earn fees for directing vote escrow tokens. Liquid staking derivatives. Maintain liquidity while earning staking rewards. Best for advanced users wanting to maximize returns from governance tokens. Strategy 4. Multi-chain yield optimization. Optimize yields across different blockchain networks. Monitor yield opportunities across Ethereum, Polygon, Arbitrum, etc. Factor in bridge costs and risks when moving between chains. Understand different risk profiles of various chains. Best for users comfortable with multi-chain complexity. Implementation framework. Start with single chain, simple strategies. Master risk management before pursuing higher yields. Gradually add complexity as you gain experience. Always understand the underlying mechanisms generating yield. Professional DeFi investors use systematic tools and processes for monitoring and optimization. Essential DeFi tools: DBank Zapper. Portfolio tracking across multiple wallets and chains. DeFi Pulse, DeFi Llama, protocol, TVL, and yield tracking. YearnWatch, advanced yield strategy monitoring, Dune Analytics. Custom dashboards for protocol analysis, APY. Vision, impermanent loss and LP performance tracking. Monitoring framework, daily checks, portfolio performance and any significant changes. New security alerts or protocol announcements. Yield rate changes that might require rebalancing. Weekly analysis, performance attribution across different strategies. Risk assessment of current positions. Evaluation of new opportunities and protocols. Monthly review, comprehensive portfolio review and rebalancing, strategy performance analysis and optimization risk. Tolerance reassessment and allocation adjustments. Performance tracking, track more than just APY. Risk-adjusted returns, return per unit of risk taken, impermanent loss impact, how much IL affected LP positions, gas costs, total transaction fees as percentage of returns. Time investment, factor in research and management time costs. Tax considerations, DeFi activities can create complex tax situations. Yield farming rewards are generally taxable income. Impermanent loss may or may not be deductible, jurisdiction dependent. Token swaps within strategies may create taxable events. Keep detailed records of all transactions and yields. Understanding where DeFi yield generation is heading helps position for long term success. Institutional adoption, impact. As institutions enter DeFi, yields will likely compress toward traditional finance levels, but total market size will expand dramatically. Sophisticated strategies will become more accessible. Regulatory clarity will reduce some risks while adding compliance costs. Technology, evolution, new developments will create new yield opportunities. Layer 2 scaling reducing transaction costs, cross-chain protocols enabling more sophisticated strategies. Privacy protocols creating new yield mechanisms, AI and automation improving yield optimization. Regulatory considerations. Evolving regulations will reshape DeFi yield. Know your customer. KYC requirements may be implemented. Tax reporting requirements will become more standardized. Some current strategies may become restricted, but regulatory clarity could attract more institutional capital. Sustainable yield models. Focus is shifting toward sustainable yield sources. Real revenue from actual economic activity. Less reliance on token inflation for yield generation. More sophisticated risk assessment and pricing integration with traditional financial services. DeFi yield generation represents one of the most significant innovations in finance, but success requires systematic approaches rather than yield chasing. The opportunities are real, but so are the risks. Here's how to start building your DeFi yield strategy. First, subscribe to this channel for more institutional level DeFi education that focuses on sustainable, risk managed approaches to decentralized finance. Second, start small with blue chip protocols like Aave or Compound before moving to more complex strategies. Learn the fundamentals thoroughly before pursuing higher yields. Finally, share in the comments what your biggest DeFi challenge is, whether it's understanding impermanent loss, evaluating protocol safety, or building a diversified yield strategy. I'll provide specific guidance. Remember, the goal isn't to find the highest yield, it's to build sustainable, risk adjusted returns that compound over time. Master the fundamentals, manage risk systematically, and the yields will follow.